Last class we've discussed about few ratios and the ratio analysis. Some of the questions which we can solve in the class, I will take you through that. Um, there is a question here on the screen 124. An analyst gathered the following data about a company. We have current liabilities, total debt, working capital, capital expenditure, total assets, cash flows from operations. Fill in the gaps in the statements below. If the company would like a current ratio of 2, it could dash current assets by 100 or dash current liabilities by 50. So there are only two options given, increase and decrease. So that is what is given. So now we have to figure it out what would happen to the, we have the values given. The first we need to figure out what are the current assets and current liabilities. We see that the current assets are 300. Okay. Working capital is 200. What is working capital?
Current assets minus current liabilities.
Current assets minus current liabilities. So if we are putting it across, working capital is equal to current assets minus current liabilities. So this is equal to, we can put it as working capital is already given as 200. Done. So current liabilities are also known to us. We do not know what are current assets. Current assets minus 300 is equal to 200. So current assets is equal to, so obviously we understand 300 goes to the other side, it becomes 500. So now present current ratio. Present current ratio is equal to, we see current assets, we got it as 500 divided by current liabilities are 300. So this is equal to, how much would that be?
1.667.
1.667. Now the question says, if the company would like a current ratio of 2, it could dash current assets by 100. So current assets, see the ratio is lower than 2. To have it as 2, whatever are the current liabilities, exactly the double should be the current assets. So 300 are the current liabilities, so current assets should be 600, double the amount, because 2 is to 1, no? So double the amount. So it says that by 100, it's already given current assets by 100. So it means to say that it should be increased. The first blank we have it as increase. Either that or the current liabilities by 50. So already current assets are 500. So half of it becomes 250. But at present they are at 300. So make it as decrease the current liabilities by 50. Very, very basic question. I mean, are they under the impression that today is a holiday or something? Tomorrow anyway is a holiday, but what about today?
No, ma'am.
There's no such thing, no?
No, no.
Another question, what is the operational gearing of CHAM company to 1 decimal point? Operating gearing is equal to, basically operating gearing ratio is finding out what is the proportion between the fixed cost and the variable cost. So out of the total cost, what is the percentage of fixed cost? That's one way. Or we just find out the proportion of fixed cost and variable cost. So that is operating gearing. So let's get back to the Excel file. It says that find out what is the operating gearing of CHAMP company to one decimal point. We have sales, we have cost of sales, then profit before interest and tax, interest, profit before tax, sales, tax, profit after tax, profit before tax, tax, and profit after tax. And then it says that 70% of the cost of sales is variable cost. So from the list of items under the income statement, we see that the operating expenses are only one item, which is cost of sales. Cost of sales, it says that variable cost is 70%. So the rest of that 30% is fixed cost. So if we are finding out the percentage of fixed cost, so we can check it out that out of 100,000, if 70%, 70,000 is variable cost, 30,000 out of 100,000 would be fixed cost. So here we are finding out operating gearing. Operating gearing is equal to uh, basically gearing ratios are in relation to fixed cost. Fixed cost by what is the proportion of variable cost. So we get variable cost as 70% of 100,000. 70% of 100,000. Okay. So how much would that be?
70,000.
Yeah, 70,000. So uh, just a minute. Wait a mistake. So we have 70,000 as variable cost. You can write it here. Variable cost is equal to um, as, no, 30%, no, 30, 70,000. After that, we have the fixed cost. Fixed cost is equal to 30,000. So basically, out of this is equal to 30%. Simple. There is no issue with that. Another way of testing it is operating gearing ratio. I'll put you through the PPT. There is another ratio also which is given below. It says that percentage change in EBIT by percentage change in turnover. So this one talks about if there is a change in turnover or sales, what is the impact it will have on EBIT. But in this present question, we do not have any changes mentioned. This is only a static situation for one particular period. The income statement is given. The second one talks about what impact will it have on the operating profit, which is EBIT, because there is a change in sales. But when we do not have anything like that, then in that case, we only test with what is the amount of contribution divided by EBIT. Contribution by EBIT. Why are we basically testing out that one? Since if we are putting this one, this becomes variable and this becomes fixed. There are two components given. So sales minus variable cost. Sales minus variable cost is contribution. So until contribution is calculated, everything is proportionate. Okay. The situation arises only because of fixed cost. Fixed cost does not change. When fixed cost does not change, so we are testing out because of fixed cost what is the difference between the contribution and the EBIT part of it, that we present it as a fraction. So contribution we would get it as If I put sales is equal to, this is 100,000. Then sales minus variable cost is contribution will become,
Ma'am, sales is
I
180,000.
know, I realized it just now. Then EBIT is equal to, EBIT is equal to contribution minus fixed cost. Okay. So we get it as they want only till one decimal point. So it would be 1.4 times. No one joined. Maybe because the recordings are there or something like that. Do you think so?
No, ma'am, I have no idea why students haven't joined.
Question number 142. Uh, the following data relates to an all equity financed company. Dividend just paid, earnings retained and invested, return on investments, cost of equity 25%. What is the market value of the company? To the nearest $1 million market value of the company. Maybe we will take it up little later because I need to talk about the valuation of the firm. So we'll do 148. We'll wait until at least another one or two students join, then I'll start the next topic for today. Until then, I'm just working out few questions. P2P ALC had made an offer. This one is the same thing. 149 will work it out. Spanner company has paid the following dividends per share in recent years. We have years 2013. No, I have made you work out this one, no? The previous class. For a period of when it is 4, we take only for 3 years. Yeah, we finished this one. This is also. Okay, we'll continue with the PPT. Did you put the message, ma? Ashley, in the group?
Yes, ma'am.
Anyone responded?
No, not yet, ma'am.
Individually, do you have any doubt? You thought of clarifying anything?
Ma'am, I had few doubts in the topic that you will be covering today.
Okay, valuation.
I read before, otherwise it goes over my head. Topics. That's why.
Okay. You want me to first teach, then we'll go ahead, or you have your doubts, so you put it across, then I will cater to that specific need while explaining the concept also.
All right, ma'am. So I had a specific doubts in futures and options.
I will not teach futures and options today because we still have to do business valuation. Futures and options, I will be doing it um, Wednesday. Wednesday we will start
All right, ma'am. All
because we
right.
still have this valuation still remaining, isn't it? Business valuations are there, and the after these valuation we have the um, efficiency theory is also there. There is a weak form, semi form, strong, and strong form of markets. These
Okay.
topics, if they are done, then we will come to the risk part of it and the financial. Um, I mean, the derivatives. What doubts you have about it, we will start with that from Wednesday onwards.
All right, ma'am.
Okay, the next topic what we come to here is business valuation. I have done all the ratios, isn't it, the other day?
Yes, ma'am.
Okay, business valuation. That's the next topic. How is a business valued is the topic. So there are various models which are present. We have these models given as dividend based on the dividend growth model. Then we have asset based valuations, price earnings ratio, and discounted cash flow basis. So to find out what is the value of a firm, these are the models which are present, which are available. So here it says that for the dividend growth model, how do we calculate what is the value of the business valuation? Did we discuss it with the help of dividend? Do you think? Do you remember anything about valuation?
No, ma'am.
We've done dividend. The market value of shares based on the dividend model. What does it say? Market value of ordinary share capital is equal to D1 by
1 plus G.
KE minus G. Market value of shares KE minus G. So we've learned it as with the help of dividend growth model. So when there is a growth, so we find out what is P0. P0 is the market value. P0 is equal to the dividends are expected to grow. So we do not write D, but we write D1. D1 is an indication that from DO it would grow at the rate of 1 plus G divided by the cost of equity minus the growth rate is what is P0. So cost of equity minus growth rate gives us what is the market value of the equity capital. So dividend growth model. So this is called as dividend growth model. KE is equal to D1 by P0 plus G, or P0 which is the market value. We have to find out what is the market value of ordinary shares. We take it as um, KE is P0 is equal to D1 by KE minus G. One or two simple questions we have also solved in the last chapter. So if time permits, maybe we will go to the essay type of questions and work out those questions. The next one we see it as asset based valuation. If you're talking about asset based valuation, under that we see net assets are taken according to the balance sheet. Then net realizable value, what is that net realizable value? Realizable value, see, assets are recorded in the books of accounts at their original cost, or what we call it as historical cost. Subject to some adjustment of depreciation, we keep adjusting the value of the asset according to the market value, or according to the method of depreciation. We assume that the value of asset would reduce by this percentage, and then bring down the value of the asset. And the written down value is a value which is assumed to be realized when the asset is sold. Fine. But all the time it is not necessary that whatever is appearing in the books of accounts will be the value which can be realized on sale of those assets. So here we see that net realizable value has to be calculated if it is to be liquidated. Is a situation where they are winding up the company, they are selling away all their assets. So in that case the assets are to be sold. So the net realizable value, if the company were to liquidate, that is what has to be um, calculated. Then if it is not to be liquidated, then we see that the replacement cost of the assets has to be calculated. Replacement cost, the cost of setting up a similar company, has to be calculated. Then find out what is the amount which can be realized if they are liquidating, or if they have to replace that, what is that has to be looked into. Now here the issue with asset based model is, theoretically the assets are recorded as at their book value, but now there are many assumptions or reasons why they are adopting a particular depreciation method, or the way they charge the amount of depreciation, bring down the written down value of written down value. So there are different reasons behind that. Okay. Sometimes they want to show more amount of depreciation so that the profits are reduced. When the profits are reduced, there is a cost advantage, or they assume that the asset would last for a longer period of time. So they show evenly the depreciation amount. So like that, depending on the usage, depending on the intention of how much the cost savings in the form of tax savings they want to take up. So there are reasons why something is adopted, and that is uniformly followed. Now when the market values are realized, so here in this case when we are looking at the assets when they are liquidated, or when they are finding out what is the replacement value of the assets, some of the assets do not realize any value. Okay. If they are there, they can get the benefit of that, they can get the benefit out of using the assets. But if they were to liquidate, or if they have to replace that, some of the assets do not have any realizable value. Like goodwill, it gives them some benefit when they are using that, but have if they have to sell that, does it realize anything? No. Certain assets can be utilized and can be derived, but we do not see them realizing any value on sale. All the most of the intangible assets, we do not find them useful um, that they can realize some amount of cash. So asset based value method has its own set of disadvantages. The historical value, the book value, the original cost value, which is accounted in the books of account, that may not be the true value which is prevailing in the market. The fair market value may be drastically very different. That is, if there are technologically many advancements happening in the market, and then their assets do not, maybe they do not. Are they are not considered anything worth because of the technological advancement. They may not realize absolutely anything, very, or some of the assets, the prices may be drastically different. That is, the market value may be very high, the value may be very low. So if that is the situation, um, valuing the business with the help of asset based model brings about certain advantages and disadvantages, because they already have presented the assets at a book value, that is, after making any certain deductions or in the form of depreciation and all, they've already made that. So it gives a rough idea about what is the value of the business, because they are all recorded in the books of accounts, so they understand that what is the estimated value of the business that can be known. But just like I have mentioned, that some of the assets do not realize any value, if they have to be liquidated or replaced, then we see that many of the assets do not cannot be converted into cash, and therefore this method does not this method does not reflect the true value of the business. The value of the business may be drastically very low. So that is a weakness or the disadvantage of value based method. Another method, the second method, price earnings ratio model. Just 1 second. Okay, the next method is called as price earnings ratio model. It says that it is an income based model. So focusing on what is the income or the earnings or the price earnings, what we are talking about. So this model is not about the assets which are recorded in the books of account, but it is about the possibility, what is the present amount of earnings which are earned. So based on that, it is calculated. What is price earnings model? The ratio for the price earnings formula, P by is E. The other day I have explained to you that it should be as price divided by earnings. Price is given as market price per share divided by earnings per share. So market price per share divided by EPS, MPS divided by EPS. So the value, the market value of share can be calculated as EPS goes to the other side. We see that EPS into price earnings ratio. So depending on what is their present earnings capacity or present earnings, which are calculated as earnings per share, Based on that, they can also find out what is the market price per share. So, using an adjusted price earnings multiple from a similar quoted company or industry average. So, here either if they do not understand what is the market value of their shares, or then they can adopt it from a similar quoted company or industry average. So, take unadjusted price earnings multiple and apply it here for the present company and find out what is the value of company. Value of company is total earnings into price earnings per share, or per share. If you have to find out what is earnings per share, multiply it into price earnings ratio. So the value of the company is calculated based on what is the earnings of the company. The first model was what are the assets of the company. It is calculated as what is the value of the company. So more or less, I mean, the assets which are recorded in the books of accounts will reflect the value of the business. But when we get into the intricacies of that, we understand that some of the assets, though they are recorded, they do not realize any value. Second one is, at present, what is that the income they are generating, that can reflect their position, that can reflect their valuation. So the valuation is based on their present earning capacity. So we take the formula of price earnings ratio, take the price earnings ratio, um, and find out what is the present market value of a single share. When we multiply into all the total number of shares, we can also find out what is the value of the company. Value of the company is equal to total earnings into price earnings ratio. What are the disadvantages, or what are the problems which are associated with that? The problems are finding a similar quoted company. So it should be on par with this particular company in terms of everything, in the activity, the capacity level, and other attributes. So it should be on par with this company. So that could be a problem. Identifying required adjustments. So because here we are saying that using an adjusted price earnings multiple from a similar quoted company. So what are the adjustments? Identify that and then make the adjustments. So what are the adjustments? Identifying that also is a difficulty. Next one talks about marketability discount to reflect that the shares aren't quoted. Marketability discount to reflect that the shares aren't quoted. So you must have learned about what is a quoted company. So finding out, making those adjustments, because it is a quoted company. So find out what is that, and then make the adjustments about it, and then which can reflect the true value of this particular company. So making those adjustments to the price earnings ratio, to find out the adjustments, then make the adjustments and suiting it according to the marketability of this particular company. Marketability discount to reflect that the shares aren't quoted. So making those adjustments. Then we see first one is based on the dividend growth model. The second one is about the assets. The third one is about the price earnings ratio. Fourth one talks about discounted cash flow model. Um, growth Dividend growth model, it is exclusively based on the dividend part of it. Assets are their present financial position is taken into consideration, the assets are taken and the value is calculated. Third one is the present earnings position, it is taken and calculated. Fourth one, when we are talking about discounted cash flows, these cash flows relate to the future period. So from the future, whatever are the future cash flows, those future cash flows are anticipated future cash flows. But we already know that the future cash flows do not have the same present value. As the time passes by, we see that the future cash flows have a lesser or a discounted value. So all the anticipated future cash flows have to be discounted according to the present value, and then calculate what is the market value. So discounted cash flow basis, it says that calculate a company wide NPV using details of all future company cash flows. So anticipate all the possible future cash flows of the company, then select an appropriate discount rate, calculate what is the present value of the company based on the future anticipated cash flows. That's the fourth model. Okay. What are the problems? So, estimating, is it such a simple task that the future cash flows can be very easily predicted? So, there is a problem with that. So, it says that it relies on estimates of both cash flows and discount rates. It assumes discount rate and tax rates are constant through the period. But would you say, let's say that if from a company there are projects which can give cash flows for the next 10 years, so is that possible that the tax rate would be same throughout the next 10 years, or the discount rate would be the same? No. As the time passes by, we see the risk also increases. When the risk increases, we have to use a higher discount rate, because to adjust the risk part of it, discount rate also has to be adjusted. So it assumes discount rate and tax rates are constant through the period. So that is not the reality. That is not what is a possibility. So we see that that doesn't work out. Then it does not evaluate further options. So it's only estimating the future cash flows, take a discount rate or a tax rate as which are to be constant values, and then discount that. But no other adjustments, risk based adjustments are not taken into consideration. There may be later on additions or expansions to the projects, or additional cash outflows are needed. Those all things mm, are maybe not intricately included into that. Some other risk may affect the business is not included. It is only based on what are the future cash flows which are which would be generated. Take them, discount them, find out what is the present value. So it, in simple terms, we're just calculating what is the net present value of all the future cash flows. So that is NPV calculation, and with the help of that, find out what is the present market value of the company. Learn this from the examination kit. No, not examination. The study text which is there. Please study from this one. I hope you have the study text and the um, exam kit. Do you have, all of you?
Yes, ma'am.
Okay. Please go through that content and learn that. The next one, did someone join? Okay, Manita Huja has joined. Okay. The next topic. Now, these are efficiency theories. So, there are three different forms of market. The concept talks about there are three different types of markets. So, markets which are in the weak form, which are in the semi-strong form, and which are in the strong form. So, how do we define that, whether they are weak or semi-strong or strong? It all depends on whether information is available. So, generally, we see that the markets what we are talking about is the markets where the securities are traded, the stock market. So they the prices in the stock market for the securities keep varying based on some information which is received. So it is all related to the information. So once an information is received, based on that, the demand, um, the demand for the securities rises or falls. When we see that there is a rise in the demand for the securities, the price also rises, because more investors are interested to buy. When when there are more number of investors to buy the securities, we see that the price rises. When there are disinterested to hold the securities, when the demand reduces, then the price falls. So it is all based on uh, information. So information is the crucial thing here, what we are talking about. So once people have the information, then they respond to the information, they take decisions based on the information, and that gets reflected in the securities prices, the share prices. They either rise or fall. They rise because the demand rises. The demand rises because there is some favorable information received towards that. So very crucial things. Any Let's say that the government comes out with a budget, so immediately after that there would be a report talking about what happened in the stock market. Why would they react to when a budget is announced by the government? So they draw these points from the budgets, looking at what are the favorable points affecting a particular type of industry, or unfavorable things. Maybe something is not given as a subsidy grant, or some favorable news for a future prospect of that business, whether it has come out or not. That is what they draw conclusions from. So then immediately we see that the stock markets either rise or fall. Okay. Then examples are, let's say that the weather report comes out stating that the monsoons would be delayed. So all those companies which are dealing with the agricultural products, they get affected. They understand that yes, the produce would be delayed, the crop would be delayed, and so some kind of thing. So when the oil prices rise, then those companies dealing with the, so like that we see that there is either a rise or a fall. It is all based on an anticipated assumption that the performance of the company gets affected according to a particular pattern, and then we see that the prices of the securities also keep varying accordingly. So if there is a weak form of market, so weak form of market, it says that share prices reflect all known publicly available past information. So they are all dependent on past information. There is no up to date information which is available to them, based on that which wherein they can respond and take decisions. It is only whatever is the past data, the same past data is available to the markets also. So the investors are not supplied with the latest, the current information, so they have to depend their decision on the past performance. What is the performance in the past? Not necessary that it would continue in the present as well. So the present, there may be many changes, and then therefore to accommodate themselves according to the present changes, no information is available to them. That's why, because the lack of information, that's why we call the markets to be as weak form of markets. So, um, it is only the past information which is available, but not the current information which is available. Then it says that it is impossible to predict future share price movements from historical patterns. So what happened in the past, how can we assume the same thing would happen in the present or in the future? It is not it is not at all the appropriate way. See, anything can happen anytime. So recently we've come across that who's the world's richest person? Who's the world's richest person? The one who has come out with the electrical cars.
Elon Musk.
Uh, from which place did he rise up to the first place? We see that there was a drastic change in the position of the person who's the world's richest. Earlier, who was the um, richest person till last year, or specifically last year? What do we see?
Was
Amazon owner, Bezos, isn't it? So this person has moved. Ellen has moved from 35th place to first place. So just in a period of 1 year, we see that there is so much of drastic change. So based on the current scenario, the latest thing, whatever, suddenly now we see that there is a huge demand for electric cars. Then the whole thing, because that particular company is also venturing into space, also taking up newer innovative ideas. Therefore, we see that there is a huge drastic change in the way it is perceived. If such information is not available, depending only on the past information, if we have to take decisions in the past period, based on the past period, see, last year was kind of a gloomy year. So can we expect the same thing to happen? People are anticipating that the vaccine will bring life back to normal. So we cannot apply what happened in the last year to this year. Last year was a different thing. This year would be a different way in which things would happen. So because what would happen, that the information, what are the present and the future anticipated information is not available to the markets, they have to take their decisions based on what happened in the past period. So that would not be an appropriate one. If that is not an appropriate one, then we can call this one to be as a weak form of market. So impossible to predict future share price movements from the historical patterns. Share prices follow a random walk. Okay, so there is no concrete basis what we can assign to the way in which the share prices are changing. So randomly some value would be there to the share price, because it is not the appropriate amount of information which is available to the investors based on which they can. So it is only taking a chance about investing into a particular type of shares or securities, and then wait until something good happen. So it is a random walk. It is not based on concrete information which is available to them, so that they can take decisions, investment decisions. If it is a semi-strong form of market, okay, if it is a semi-strong form of market, share prices reflect historical information about companies and respond immediately to other current publicly available information. Yes, they depend on the past historical value. They depend on historical value, but at the same time, they also see that share prices reflect historical information about companies and respond immediately to other current publicly available information. So, if there is anything available, they also respond to that publicly available information. Then it says that evidence suggests most leading stock markets are semi-strong, efficient. That is, it is not in the information is not instantly available that they can respond to that and then take a decision. So only they have to wait until some information is publicly available. So um, that current updated information, since it is not available, they are depending on the past data, but then until some information is publicly announced and available for them, they have to wait until that and then take decisions based on that. So since it is not currently updated information which is available, we can look at this one as a semi strong form of market. Then the next one is a strong form of market. Strong form of market says that share prices reflect all information about companies, including information that has not yet been made public. So that public announcement has not yet come, but yet there is some way in which the information is passed on to the investors. That is maybe some predicted value, some future. See, even before the election result is announced, we have certain surveys and polls and which are carried out, which are taken up, and then they kind of predict the value of who would win. Most of the time, we see that the result is close to their anticipated or their pre-forecasted or based on certain surveys and feedbacks collected, they also come out with some kind of information about who would win in the elections and all. Such kind of things are, see, even before they are made publicly available, yet there is some kind of information which is available. So they can work out towards that particular things, because there's some forecasting, there's some estimation is done. They can work out towards that. So share prices reflect all information about companies, including information that has not yet been made public. Then it says that a publication of new information does not impact the share price. It is unlikely that this strong form of market exists in reality. So does it actually exist that every piece of every bit of information is instantly available to them, or even if it is not announced, but some way in which maybe some estimations or some forecastings are taken up, and then they can come close to that. Such type of markets, we do not see that they actually in reality exist. So it is unlikely that a strong form of markets exist in reality. So this is market efficiencies. The various types of efficiency. The first one is the weak form of market. The second one talks about semi strong form of market. The third one talks about strong form of market. There are three different types of markets. All of them are categorized based on the whether the information is available or not. If the information is available, then investors can take better decisions um, based on the information that is available to them. I hope that's clear.
Yes, ma'am.
We'll work out some of the questions which are there. Mm, on the screen, do you see question number 142? The following data relates to an all equity financed company. Dividend just paid is given. Equity earnings retained and invested are 70%. Return on investments is 15%. Cost of equity is 25%. Find out what is the market value of the company. Very simple. So find out what is the market value of the company. How do we calculate such a question? Market value of the company. Based on the dividend growth model, based on the dividend growth model, market value of the company based on the, because we see that the information about dividend and the retained earnings, the cost of equity, cost of return on investment, this is given. We have to adopt the dividend growth model only, market value models. We have to depend on dividend growth model only. So market value of the company is equal to, what is the formula? We have D1 by um, we have D1 by KE minus G. So let's check whether we have all the variables. Do we have D1? D1 is the dividend which has to be paid at the end of the period. So the amount of dividend, the dividend which is paid just now, the dividend which is paid just now is 50 million. Then this has to grow. D1 is equal to DO by DO into 1 plus G. So then only we can find out what is, do we know what is KE? KE is given to us. KE is equal to, it's already mentioned as 25%. G is not there. Unless and until we know G, we will not be able to work out what is D1. So G is not there. What is the formula for G?
R into V.
R into B. R into B. So here it could be R is return on investment. R is equal to 15%. Okay. B is equal to um, earnings retained and invested are 70%. So the retention ratio is given as 70%. So B is equal to 70%. So if they are retaining 70%, these 70% which are retained also will earn a return at the rate of 15%. So G is equal to R into B, which will be is equal to 70% into 15%. Did you get the answer? So let's work it out. What is dividend? Got the answer? No one's responding.
It's something 396. Sure,
the
sure.
final answer. But 396 is not there, no?
Ma'am, 381 million.
81, okay. So D1 we got it as 55.25, okay, divided by the return on investment is 15%, 15% minus 10.5%. Okay. Answer is 381. So 381 is the answer. The following information relates to two companies, Alpha PLC and Beta PLC. We have the earnings after tax price earnings ratio for both the companies, Alpha PLC and Beta PLC. Then Beta PLC's management estimate that if they were to acquire Alpha PLC, they could save 100,000 annually after tax on administrative costs in running the new joint company. Additionally, they estimate that the price earnings ratio of the new company would be 18. On the basis of these estimates, what is the maximum that the shareholders of Beta PLC should pay for the entire share capital of Alpha PLC? So here we see that there are two different companies, Alpha company and Beta company. The earnings after taxes are given, the price earnings ratio is given. Now Beta company is estimating, Beta PLC management estimate that if they were to acquire, so Beta wants to acquire Alpha. So if they want to acquire Alpha, um, they could save 100,000 annually after tax and administrative costs in running the new joint company. So they are looking at some benefit if they take over another company. So that is, they would be saving this much amount of cost, administrative cost in running the new joint company. Additionally, they estimate that the price earnings ratio of the new company would be 80. This is what they are anticipating. Based on the basis of these estimates, what is the maximum that the shareholders of Beta PLC should pay for the entire share capital of um, Alpha PLC? So entire share capital. Uh, the values are given to us based on the price earnings ratio. Price earnings ratio is uh, the present um, earnings position. So price earnings ratio talks about the present situation. So based on that, how much how much would they have to spend to get the total value of the I mean total company. So first they need to find out what is the value of the company. What do you think would be the right thing?
Ma'am, if we get the value of the entire alpha plus beta and we subtract the value of beta, then we'll get the value of alpha.
Okay. Because it would become a consolidated joint venture, so it would be a total one. So here they are looking at that a benefit in terms of their annual cost would be 100,000. So that's a benefit. So the new joint venture, if they get to acquire alpha company, then they are looking at their value in terms of how much would they save as 100,000. Fine. Next one, they are also anticipating their price earnings ratio to be as 18. If that price earnings ratio is 18, um, the present values of these things, that is the earnings of alpha and the earnings of beta added together, plus cost savings is also an income. Any cost saving is an income that is treated as a profit, or it is treated as an income. So at present, whatever alpha has earned their income, then the earnings of the second company beta, plus they are anticipating that the cost saving is also a profit, that would be to the extent of 100,000. Add them up, all the three amounts have to be added up, that is 210,000 plus 900,000 plus 100,000. All the three of them have to be added for the new company. So because we are calculating the value of the company based on the present situation, so if this happens immediately, the total value of the company stands at, um, let me put it to, uh, so how is this calculated? Based on that, the total earnings into the price earnings ratio, the total earnings of the joint venture, that is after acquiring. See, let's calculate estimated value earnings of alpha plus earnings of beta plus the cost savings, that is another benefit, 100,000 cost benefit. All of them have to be multiplied. This is the total earnings into price earnings ratio. So after the acquisition happens, the price earnings ratio is anticipated to be at 18 times. So into 18. So tell me how much would that be?
$21.78 million.
Is this not the answer?
Yes, ma'am, it's the same.
Okay. Did we do it correctly? The answer is not.
Yes, ma'am, they have rounded off the figure. That's 2.9 million.
Okay, okay. Okay. A small question. Similar thing, just now what we have done. The following data relate to an all equity financed company, dividend just paid, earnings retained and invested, return on investment, cost of equity. A similar one. What is the market value to the nearest 1000? You can work it out. We have done a similar one just now. So I think you can work out this one.
Yes, ma'am.
Okay. After that, I think we've done this also last class.
Yes, ma'am, we did that.
Historical growth rate model. So we take the growth rate to be as because there is no R and retention ratio, but dividends are spread over 4 years period, taking 3 years period, that is dividend paid in the current dividend divided by what is the dividend paid in the last period. So to this one we find out to the power to the root of n minus 1, that is 4 are given, we take it as 1 year less from the total calculated value minus 1, then we calculate what is growth rate, apply that growth rate and then find out what is the d0 is given 36, then we find out what is d1, after we find out d1 by ke is 16 minus g. Then we see toggle company has an issue, sorry, 152. How do we work out 152? It says that a company has just paid an ordinary share dividend of 32 cents and is expected to pay a dividend of 33.6 cents in 1 year's time. The company has a cost of equity of 13%. I think we tried this one on There is a time period of only 1 year in 1 year's time. So from the end of in a time span of 1 year, so that is ordinary share dividend of 32 cents is expected to be to pay a dividend of 33.6 cents in 1 year's time. So within a 1 year time period, there is a growth of from 32 it has grown to 33.6. Just calculate what is growth rate. Already we have what is cost of equity. D is there and the D1 is 33.6. Quickly calculate that and substitute and tell me what's the value.
Yes, ma'am, we did that. Growth rate will be 5%,
Ah, okay,
and
good.
market price will be 420 cents, that is $4.20.
Okay, done. Um, Then 153, question number 153. The Toggle company has an issue of 6% loan notes which are redeemable at their nominal value of 100 in 3 years' time. Alternatively, each loan can be converted on that date into 30 ordinary shares of the company. The current ordinary share price of Toggle company is 3.50 and that is expected to grow at 4% per year for the foreseeable future. Toggle company has a pre-tax cost of debt of 5% per year. What is the current market value of each $100 convertible loan note? We have to find out what is the current market value. The terms are given as the loan notes have um, a percentage of interest mentioned at 6%. Um, then which are redeemable at a nominal value of 100 in 3 years. Alternatively, each loan may be converted on that date into 30 ordinary shares. So these are convertible debt capital. This debt capital gets converted into equity at the end of 3 years period into 30 ordinary shares. The current ordinary share price of Toggle is company is 3.50 and this is expected to grow at 4% per year for the foreseeable future. We need to find out what is the pre-tax cost of debt. No, the pre-tax cost of debt of is given as 5% per annum. What is the current market value? Any clue as to how we would be proceeding further? So the first we because the conversion would happen at the end of 3 years. So then at the end of 3 years, we need to find out what are the values. So the loan gets converted into 30 ordinary shares. If we are finding out the present market value, P0 is equal to, what do we write? We write D1. That is dividend at the end of the period. If we are to find out what is the present value, we have to take the dividend at the end of the at end of 1 year divided by, we have to take KE minus G. But if we are, let's say, if we are finding out what is the present value at the end of 3 years, it would be taken as today's value is 0. 1 year later value will be P1. 2 years later value will be P2. And 3 years later value should be P3. So P3 is equal to D4. It becomes D4 divided by KE minus G. So we need to first find out what is the value which is there at the end of the 3 years period, because the conversion is what would happen at the end of 3 years period. So first we need to find out what is the present, what is the value of the shares at the end of 3 years period. So first we need to let me put it here. P3 is equal to D4 by in bracket KE minus G. So let's keep a track of what is the different details given to us. The current ordinary share price of toggle company is 3.50, and that is expected to grow at 4%. So what is that we can find out from this information? Current market price, which is equal to P0. P0 is 3.5. Okay, growth is 4%. Fine. Um, in that case, so we see that the only thing what would change, because KE and G would be the same even after 3 years. It is all what would change will be based on how dividend will change. So whatever is D1 as of now, whatever is D1, this will keep growing until it becomes D4. They will grow with the growth rate of um, 4%. So if D1 is equal to, if P0, we see P0, P0 is only given, D1 is not given. If P0 is equal to 3.5, the current ordinary price is 3.5. By the time it becomes P3, the KE and G in both the equations we see is common. So D1, if it becomes D4, we can find out what is P3. So P0 being, this one being 3.5. Okay, if this is 3.5, P0 is 3.5, the difference between P0 and P3 is all the other factors being constant, KE and G being constant, D1 is only changing to D4. So if the D1 becoming D4 would be D1 into 1 plus G into 1 plus G into 1 plus G. So 1 plus G has to be multiplied 3 times, it has to be multiplied. So if that growth rate is multiplied 3 times, that is the, um, if we are talking about P3 is equal to PO into 1 plus G. See, each year it would keep growing according to what is the growth rate. So, into 1 plus G, into 1 plus G, into 1 plus G. So, the whole thing to the power of 3, it becomes P3 is equal to, because the difference between P0 and P3 is all because of, it is all because of growth rate. And growth rate is also mentioned to us. What is growth rate mentioned to us? Growth rate is mentioned as 4% for the for the future period. It is at the rate of 4% it would grow. So we have P0, we also have G which is equal to 4%. So can we find out what is the value of P3? So P0 is equal to 3.5 into 1 plus 4% to the power of 3. Okay. Um, P0 when we have calculated, uh, P0 is calculated as per share, P3 calculated is 3.937024. But the convertible notes will get converted into 30 ordinary shares. So find out what is the value of 30 ordinary shares at the end of 3 years. So let's put it as value of 30 ordinary shares at the end of years is equal to, we just have to multiply 30 into 30.93. 94, let's put it as, is equal to, so we got something as 118.1107. Okay. When would this conversion happen? This conversion will happen 3 years later. So at that time, what is the value of this loan capital? Loan amount of 6% interest rate. The nominal value is 100 in 3 years time. Okay. At that time, nominal value of $100 in 3 years time. Fine. The other details are the cost of the pre-tax cost of debt is 5% per annum. What is the current market value of $100 convertible loan note? The debt capital has two features. We see that the risk is also arising on account of two things. That is, one is the future cash flows, which are interest amount. So interest amount has to be periodically paid. So based on the future cash flows, the discounted value of the future cash flows also is taken as one basis of calculating the present value of the company. So there are future cash flows on debt capital. What are the future cash flows? The interest which would be paid at the rate of 6%. 6% only, 6%. The interest amount which is paid at the rate of 6% is one cash flow. Second aspect of it is there is a term period. Debt capital has a term period. So debt capital has a term period. At the end of the term period, whatever is the debt capital, it is there in the future. So that also has to be calculated as in terms of the present value. So the interest amounts which are anticipated for the next 3 years, because after 3 years it gets converted into ordinary shares. So for 3 years period, future interest amount has to be calculated. So the value of debt according to the interest amount and the term amount, if we are discounting them to find out what is the present value, okay, first we need to find out what is the value of debt. I have not discussed because it was not there in PPT. Value of debt can be calculated as, just now we've learned about based on the future cash flows. So let me put you to that. Based on the future cash flows, that is all the future cash flows. What are the future cash flows here? There is one interest amount, there is one term at the end of the term period, the redemption amount. So these are two future cash flows for the next 3 years. So these things, when they are discounted, also we can find out what is the value of the company or value of that particular security. So if we are finding out what is the debt capital and the debt capital uh, present value, we need to take two aspects. So there is one item, interest, interest which is paid. So this can be taken as interest And interest is periodically. It is 6% per annum. If nothing is, because the term period is not given, 6% reflects the per annum rate. So interest which is paid per annum, for how many years would it be paid? For the next 3 years it would be paid. So interest has to be calculated as discounted present value interest factor. Is it there every year? Yes, so it becomes annuity. Present value interest factor at what rate? At we see at the interest rate which is given to us, interest amount is 6%, the cost of debt capital is 5%, so we have to take it as 5% at 5%. At 5% for how long? How long is for the next 3 years? 3 years. Is that the only cash flow what we are looking at? Interest being periodically annually paid for the next 3 years, that is one future cash flow. There's another future cash flow also which would arise at the end of the 3 years period. So that is the redemption value, the redeemable value. So the maturity value, redeemable value, put it as whatever you say. So that value, the redeemable value or redeemable value into, it is only one item, into present value interest factor. It is not annuity, present value interest factor at the rate of um, there are two cash flows related to debt capital. So at the end of 3 years, the term value, whatever has to be redeemed, it is not going to be redeemed in the form of cash or whatever it is. That would get converted into 30 ordinary shares. We have already calculated the value of 30 ordinary shares. 30 ordinary shares value stands at 118.1107. So that is the value what we have calculated. So take that value, that would become the redeemable value, plus the interest amount which is at the rate of 6%. So interest will be, how much is interest? I is equal to uh, the value which is 100 into 6%, which is equal to $6. Done. So 6 should be multiplied into present value interest factor of annuity at 5%. Can you tell me what is present value interest factor of if you have table values with you, please pick out the value from the table values. Otherwise, use your calculator and tell me what is it at 5% for 3 years annuity value.
2.723.
You have picked out from the table values. Okay, let me write it. Plus, now what is the redeemable value? If nothing was there, if the loan has to be redeemed at the end of 3 years period, whatever is the value which stands at the end of third year, that will be the redeemable value. But instead of paying in the form of cash, they would be paying 30 ordinary shares. So whatever is the value of those 30 shares is the redeemable value. So the value of 30 ordinary shares at the end of 3 years, we have calculated it to be as 118.1107 into the present value interest factor. It is not now, it is not in the form of annuity. It is not in the form of annuity. So just tell me what is the table value. You should be having table values with you. Please look into that and tell me what is the table value.
0.864.
Sorry, I didn't get you. Please.
0.864.
0.864. Okay. So just calculate that. Is equal to 6 into 2.723 plus. We didn't get precisely correct. 118.38 we got. We have 118.46. What if we take this to be as a round of 13? Okay, we got maybe somewhere some rounding off has been done. So the value is 118.46. So quickly let's look into that. See, we are to find out what is the present value of the future cash flows. Present value of the future cash flows. We need to take the debt amount because we are talking about the debt value, the market value of the $100 convertible note amount. So convertible note amount, the present value. But we do not see that it is for a term period, and at the end of the term period, whatever is the amount of cash paid, it is not in the form of cash, but it is in the form of ordinary shares. So when is this redemption happening? This redemption is happening at the end of 3 years. So at the end of 3 years, they would be paid 30 ordinary shares. So first we need to find out what is the value of ordinary shares at the end of 3 years. So that will become the redeemable value. So when we calculate the value of shares at the end of 3 years, that is we find out what is P3. We got the value to be as 3.9377 793 7024. So if we take that 937 and multiply into 30 number of shares, then we got a value of 118. 118.1107. Take that 118.1107, that is the redeemable value at the end of 3 years. So finding out value of debt based on the future cash flows. The future cash flows are, one is an interest amount which is 6% on 100, which is $6. $6 into the present value interest factor for an annuity at 5% for 3 years. The factor is 2.723 plus the amount of the value of shares at the end of 3 years which would be given to them is 118 into 1.1107 into the present value factor stands at 0.864 multiplied, we get it as 118.3857. So it is something close to the fourth option. So maybe somewhere rounding of error happened. So this would become the answer. Okay. So how many are there? Only two. Ashley and Manita. Manita Hoja. So tomorrow is an holiday. Both you and I have a holiday. So we will be meeting again on Wednesday. So the number of classes what we have remaining are Wednesday, Thursday, Friday, and the coming Monday. That is first. So we would be having today's class is gone. So we would be having another 4 days, 4 classes we will have. So 4 into 2, 8 hours are present with us. So we have come to the end of these topics. So what is remaining is about the risk aspect. Only the risk part of it is there. So we would roughly go through what is macroeconomic policy, monetary policy, what are the various types of financial markets. Okay, we see the money market, the capital market, the features. I mean, what type of securities are traded and what are those things. So we need to look into that. The financial institutions, securities, and talk about the treasury function. The risks which are present, the currency risk, the after that we have the interest rate risk and how to hedge with that. So when we discuss about the securities market, what doubt you were asking, Ashley, about the futures
Future.
and options and all. At that time, I will discuss about that too. Okay, so we have done sources of finance, and from there we have done. So how do we manage these risks which are present? So we have two types of risks, that is foreign currency risk and the interest rate risk. So how to hedge those things or how to manage those risks which are present is what we are going to do. But before we discuss about the risk, we need to understand about the monetary, macroeconomic policy, monetary policy, fiscal policy, the markets, and the types of markets. These things, if we understand, then we can discuss about how to manage the foreign currency risk and interest rate risk. These two things can be learned. Okay. So the remaining 4 days, we will wind up with the syllabus. As and where some simple questions are there, we can also work it out. Okay. I'll end the class here.
Thank you so much, ma'am.
Please inform others. We just have, spend the time working out on questions. Technically, we didn't, we just covered about the valuation models and the market theories. So, if they are present there from Wednesday, we can finish up the syllabus. Okay. Good day then.